So I could use that life insurance policy like cash. I could actually buy stuff with it.
Well, you can't buy stuff with it. So how you do it is you leverage the cash that's inside of the policy. You don't actually take the cash out of the policy. You actually get a loan against it or collateralize that asset. Okay. So it's still sitting there. The bulk of the cash is sitting in there, earning interest in whatever type of an account that you have set it up and what contract it's with. And then usually the life insurance company will give you a loan against that money. So you might make 6% interest over here. The life insurance company is saying, hey, we can either do a standard loan or an index loan, depending on the type of contract that you have. And the interest rate is going to be 3 or 6%. So it's a net zero gain, right? But the money in here is compounding all the time, compounding, compounding, compounding. And with the collateral that you have against that account, you can use that money to go invest.
For people who haven't met you before, this might be the first time consuming the content. Can you give us just a quick Spark Notes version of who you are, what CWR Private Client Group is, just as a kickstart?
Yeah, definitely. So Rob Reed, with founder of CWR Private Client Group, founded about 4 years ago. So we've been handling people's retirement planning and investment advisory services for the last 4 years. Been in the business for about 21 years through the insurance and financial services sector. So I've got a wealth of knowledge on that side of it.
Awesome. Awesome. So let's go ahead and just kick it off with why should people get life insurance at all?
Yeah,
You
so that's a
know,
good question. So there's two kind of phases to life insurance that I look at. The first phase is obviously for income replacement while you're building your family, building your assets, building your net worth. Just in case the unexpected happens to you, your family will be able to take care of everything that you want them to aspire. If you want them to own a business, start a business, whatever it might be, that death benefit will take them and help them achieve the results that you always desired for your family. So that's the first piece. That's the most important piece of life insurance. And that's the foundation of any financial plan. Is it doesn't matter how much money you have, if you don't have life insurance to take care of your family 10, 20, 30, 40 years from today, then that's a huge hiccup in your
so,
financial plan.
so what if I'm getting that life insurance through my work? Let's say
Yeah.
I have a $50,000 policy with my work.
Yeah, great. So you don't own that policy. You don't have any control of that policy. If you lose your job or leave, I look at that policy as just gravy. I don't want to put my family's financial future in the hands of the company that I work for because I'm replaceable to them, but not replaceable to my family. So I don't even count that into any life insurance death benefit I ever have at all because it's always going to change. It's just extra.
Yeah. So what if I feel like that 50 would that 50,000 be enough? Should we just add another 50,000 on there, or like what is the number that you should look for? Let's say I make the average household makes 45,000.
Right. So the
Yeah.
average household makes 45,000 on the low end type thing. So when I look at that, I don't look in 50 or $100,000 increments. I ask, what is your worth to your family? Now, yeah, you're making $45,000 this year. You're married, you've got one child, or even if you're just married, what's your value to the livelihood that you've built already? And how long do you want that to continue? So first, it's if you make $50,000 a year, you should have $1 million of life insurance death benefit. If you love somebody else, I mean, it's all about that. If you don't love anybody, then don't even buy life insurance. It's worthless, right? But if you love somebody and you take care of them financially, you need to have life insurance in place. And I go in $1 million increments. That's it. If you make 50,000, you get $1 million. If you make 100,000, 2 million. If you make 200,000, 4 million. The insurance company won't allow you to over insure yourself. They will say, nope, that's too much life insurance. So that's what I'd recommend. Get the most that the company will allow you to have.
Oh, wow. Okay. Max it out. Now,
Yeah, 'cause, I mean, just think about that same way on home insurance. You have a $400,000 home. Are you insuring it for 100,000 or 400,000?
yeah, true.
Right?
Right.
Yeah. So, and I think your family is a little bit more important than your home. True.
Yeah. A little bit.
Just
Yeah.
a, just a tad. Depends on the attitude that day, right?
Right. Right. So we have that. So what? You just get whole life insurance then? You get
Yeah.
term.
Yeah, so there's several different types of insurance that you can purchase out there. So when I'm talking about death benefit and protecting income, I usually talk about term insurance. It's the cheapest coverage out there. It's going to take care of, hey, if you die, it's going to give a check to your family to continue on their life, right? That next phase, once you have that in place, then you can start using life insurance or permanent life insurance, which can be a variable universal life, a index universal life, or a whole life contract. Then you can start funding that how they should be funded. Unfortunately, only probably about 5% of all insurance agents know actually how to fund a life insurance policy on the permanent side. Because most of them will just say, well, let's just fund it. You're 25, let's put $50 a month into a $100,000 permanent life insurance policy. Well, that's just a long-term term insurance policy that might have some cash value in it, right? But the cost inside the policy outweighs the benefits when you don't set it up properly on that side of it. So once you get the term insurance taken care of, you can step over to a permanent life insurance if you want to house assets that are easily accessible. Okay. And what I mean by that is I need money for a new business opportunity or something like that. I want to have access to that money where I might not have it accessible to my 401k because I'll pay penalties and taxes on it if I need access to it. Right.
Right.
So it's about finding that person that's going to build that contract properly to do what you want it to do. And so you want to have someone that actually knows what they're talking about, which is only about 5% of all licensed life insurance agents actually know what they're talking about when it comes to that.
Yeah. As someone who's previously worked in life insurance industry, or at least the insurance industry, I definitely know that. I know a lot
Right.
of them have sold a lot of policies, had no clue what it was. So you said cash value. So I could use that life insurance policy like cash. I could actually buy stuff with it.
Well, you can't buy stuff with it. So how you do it is you leverage the cash that's inside of the policy. You don't actually take the cash out of the policy. You actually get a loan against it or collateralize that asset. Okay. So it's still sitting there. The bulk of the cash is sitting in there, earning interest in whatever type of an account that you have set it up and what contract it's with. And then usually the life insurance company will give you a loan against that money. So you might make 6% interest over here. The life insurance company is saying, hey, we can either do a standard loan or an index loan, depending on the type of contract that you have. And the interest rate is going to be 3 or 6%. So it's a net zero gain, right? But the money in here is compounding all the time, compounding, compounding, compounding. And with the collateral that you have against that account, you can use that money to go invest. Like if you're in real estate or if you see a opportunity even in the stock market to go out there and say, hey, there's a good opportunity that I can make a lot of money on this. Or I've had certain clients that work for companies that IPO'd and they needed money to go buy the stock on the IPO side of it, and they didn't have any access to it through their 401k or any other assets, right? So it's a way to leverage that life insurance cash value to go invest somewhere else. I would never recommend it to pay for lifestyle. Like, oh, I want to go buy a new Lamborghini. That's not an investment. It could be if it could go up in value, but you have to really look at it as what can I use those funds for? I usually say don't use it for lifestyle unless you really have to, but then pay yourself back so you have access to that account yet again.
That makes sense. Okay. Yeah. So it's really insurance for life then, and that's what people really need to understand. So what is so that opens up opportunities for arbitrage then, right?
Correct. So yeah, that's a key word in the life insurance business is the arbitrage between them. Sometimes you'll be able to make in that account 6%, borrow against it at a net 3% interest rate. So even at borrowing it at 3%, even if you go back out and make another 3% on that money, you're actually making money inside the account on the money that you've already got borrowed out, if that makes sense.
Yeah.
So
Yeah.
you're making the difference, the arbitrage between what you're making and how much you're paying on interest just by having that outside of the account.
So it allows basically like you to take more side hustles and allows you protection.
Correct. Yeah, exactly.
Yeah.
So it's safe and secure. It's an asset that you can use. So it's just like buying like a piece of real estate. So say you have a home and you have equity in that home, you can go to the bank and ask for a loan against that equity, right?
Right.
That and then go do whatever you want with that equity and pay it back, obviously. But it doesn't stop the home from increasing in value over time.
Yeah. Okay. Except this has a guaranteed return, whereas the home
But,
doesn't.
right. Well, it doesn't have a guaranteed return. It has a index. So like a indexed universal life has it's on an index. So it could go up in value. It's never going to lose money, but it will go up on that side of it.
Oh, well, that's great. Yeah, because you could definitely lose money on a house. So the
True.
cash.
Yes.
Yeah. Okay.
Yeah, we'll never go down below that value that you've already set aside in that account on an annual basis.
So what is that? What is uh, that product in particular? What is the name for it again?
Yeah, so there's several different types. So I use for my clients is what's called an index universal life policy. Um, so that has a floor if the market's tied to an index. So say the S&P 500, it's tied to that index and it resets every year. So if we said the S&P 500 today is at X 3800, right? And then 1 year from today, it's at 4,500. Say we had a great year, like what happened, last year, right? It went up drastically, went up a lot last year. And say we had a 20% market return that went above that. Well, that contract is going to say, well, we're going to only give you 10.5% or 12.5% of that return. We're going to cap it, right?
Right.
But the following year, if it goes from 4,500 back down to 3,800, all of a sudden you lost 20%. They're going to give you a 0% return. You're going to keep it that same static account that you were at before. Okay. So
Okay.
it keeps notching up, but it never goes back down.
It's good.
Which
And
there's some variable universal life policies out there, which that's invested into the market and that has ups and downs to it. If the market goes down, you'll see your account value go down. And I don't like those because what happens is you're putting that life insurance should be in a safe tank, an opportunity that can't lose money. If you put it into somewhere that can lose money, and say you found a real estate or an investment opportunity out there and you took a ton of money out of that account, well, all of a sudden you took $50,000 out and the account value was 60 and the market tanks and that account value now goes to 40, you're going to get a margin call from the life insurance company and said, hey, you don't have enough collateral based on that loan that you took out. So you owe us $10,000 to make that back up.
yeah.
Okay.
Which
So
could be,
index universal life is the go-to when it comes to if you want to start leveraging that account several times over and over again for investments.
okay. The time frame to pay that back works as a regular loan then?
No, you have complete control over when you pay that back. You can not pay any interest on it. You can pay interest only on it. You pick and choose when you want to pay it back.
So basically you're your own bank at that
Correct.
point.
Yeah, you're in control of that. So I have some clients that use the asset to go do home flipping, right? So they borrow the down payment because they might finance 70% of the property through a traditional bank. They pull 30% out of their account, they borrow against it, and go do their flip. They don't pay any payments during that whole entire flip of that property. No interest only, no mortgage payment, no anything except for the money that they borrowed from the true actual bank. on that side of it. So it helps with cash flow and not having to spend down during those months. But if it goes on for a year or 2 years, it doesn't matter. Now the interest compounds on an annualized basis. So it does, that 3 or 4, or whatever that interest rate is on that loan will compound each year. So I usually recommend, hey, at least pay the interest back to the account, so we're not compounding on interest.
Okay.
Yeah.
Yeah. That's really cool. Okay. And I think a lot of people don't understand that. So what is the minimum that they should have before you consider a product like that? Is there a barrier to entry based on the amount you're making right now? Could someone who, let's say your typical person out of college is like, this could be a great opportunity as I get older to always have this like, be on my own bank, basically be able to loan against myself. I don't have to worry about the payments. It gives me all this sort of flexibility. But how much can they afford it? Like, let's say they're making, you straight out of college, you're making 50,000.
Right.
Right.
Yeah. So let's take a look at that example. So the first thing is, do they have emergency cash available when something happens? Right.
Okay.
So
Right.
depending on their family status, they need about 3 to 6 months of expenses. That's what I tell folks in cash, not paycheck, not monthly paychecks, but actual expenses that you require to live, right? Your housing, your food, insurance, transportation, those things, right?
Right.
And then you say, once I built up that, and say, hey, if that $50,000 a year person, if they have $4,000 saved up, that might, and they're single, that might be like, oh, that's perfect. That's my emergency fund of cash that I can go to. Because I don't want to build that up way too high, because I'm losing opportunity on those accounts because I'm making 0.5% interest in my bank account. So once we get that going, then we have to look at, well, how much should we be saving on a regular basis to invest into, right? If I always say you should be saving 20% of your income and spending 80%. So in that example, it should be what, 50,000, 20%, that's $10,000 a year.
Hey, it's Josh here. Did you enjoy that video about life insurance? Well, guess what? We got more clips on the way, so make sure that you subscribe to the channel and maybe leave a like and comment on the video. It helps us out a lot. And remember, if you join the Discord, you can talk to people like Rob, yourself, ask him all the questions you want. He's there to help you out. And remember, if you go to cwrprivateclientgroup.com, you can also reach out and set up your policy today.